Hello guys, Luca here from ACY Securities, Technical Market Analyst, and today I have a little bit different video to do. It's basically explaining one of my economic models I've done a few weeks ago. So since I joined ACY Securities, I've been writing the posts on the website. I hope you guys are reading those posts, so then you can keep up to date with what is happening on the market and what is happening on which economy. Right, so jumping onto my screen here now, I'm just at the ACY website. If you guys go into Learn and then Market Analysis, you can read this with me as well. So if you come here, Market Analysis, come here to Market Analysis, click on my name, and then you click all the way down to page 7, and then this is the one that we're going to be discussing today. So this was posted on 9 of February, so February 9. So there is a bit of nearly a month already. And what I want to discuss is, since I've joined here and start to talk with you guys, I've, had a bit of a different view from all the market. Everyone thought that the Eurodollar, are going down and down and down. I do have this view for short term, and this is why I'm here today to discuss that we may having a turn point. So we may changing the trend, okay? And why is that? So basically, Europe, I'm gonna show everything later, but basically Europe have a big imports from China. Right now, China is closed, okay? So they are not trading with any other country. So soon as China reopen, Europe will be very, very profitable from those imports, right? So euro will be much more higher than he is right now. And then I have developed two economic models on this, and this is what I want to discuss to you today. All right, so come to my screen again. So during year 2022, the Fed made a big change in the financial policies, which had a major impact on the stock market, right? At the same time, the world's economic growth was slowing down due to both the Fed's policy and some political problems. Caused the natural gas prices to go up, right? So if we look at the prices of the gas, a few months ago, I think it was October to December, the prices was reaching all-time highs, nearly 353 euros. So Europe was very, very bad in terms of buying gas because it was so hard to buy. It was not cheaper, it was very expensive, right? This causing the euro to enter in a downtrend. But then everything came different than expected. Everyone was expecting that the winter in Europe was, be very, very cold, and then the gas prices was at all-time highs. So everyone was lost at that time. No one knows what to do. So basically, what I want to achieve here is, on that time, yes, it was a short position, a very good short position, because first of all, we had winter coming to Europe, right? So the gas prices was on the all-time highs. That's second. Third, people were afraid because the winter in Europe, it's very cold. They need the gas to heat the house, to heat the property, and have like a warm place, right? So if they don't have it, they can die, let's say, right? Well, they can't die, but they would suffer a lot, okay? So everyone was cautious about that. So what's happening next, Oh my God. And then the German just came from nowhere and say, we're going to buy the gas, doesn't matter the price it is, and we're just buying. It doesn't matter if it's $1 or it doesn't matter if it's $500, right? So they start to buy gas and more and more and more. So they built the reserve, the gas reserve, at 97%, okay? That was nearly the all-time high as well for the reserve, the gas reserve in Germany, okay? So if we think now and look at the past, everything's now makes sense, okay? So first of all, we had everyone thinking that the winter would be very, very cold, and it turned out that it was a mild weather, okay? So if we look at the temperatures usually on the winter in Europe, in Germany, Eurozone, UK, everywhere there, we can see that it's normally negative, right? So I'm talking about -1 degrees, -2 degrees, -5 degrees. But that time was different. Okay, so last winter, well, we're still technically in the winter yet in Europe. Okay, we are finishing March now, end of this month. But it's different. Why? Because the weather right now, it's close to 20 degrees, 15 to 20 degrees. So you can imagine how big is that, you know, how it's that a turn point, because the market was expecting to be very, very cold, and then Germany was already buying so much gas, there was stocking up, you know, doesn't matter how much the gas price was, so there was afraid of. So the market thought about it, okay, it may be a good short on euro, but then the turn point comes, and the mild weather came in and destroyed all of the short positions. And then this is when, if we come here to my screen, this is when all of the sudden Eurodollar just starts to rally up. Okay, so if we look at the chart here, you may think, okay, so you know we were on a downtrend, we was going down very, very like smooth. You know, we had like one leg down, a pullback, leg down, pullback, leg down, pullback, but then nowhere of sudden the market just hits up. So why is that move? Why is that move happening? That move just happened because what I've told you right now. The market had one expectation, and then everything happens in the other way. So it is much more easier to investors to start to buy euro and sell dollar on October all the way to January this year, right? But now, well, this is the last scenario, okay? But now we have to think one. I just want to show first one thing here, and then we can discuss it later. So I'm gonna put one question here, and I would like for you guys to answer in the comments to see, you know, how are they feeling about you on the economics and macroeconomics. So let's put a situation here, okay? We have China right now saying that they're gonna be reopening for full this year, 2023. Market is very happy with that, okay? So they are very, very happy because China, as we all know, it's the biggest, you know, one of the biggest economy in the world. So if they're closed, that they have been for 2 years, nearly 3 now, we can feel the effects in a daily basis. You know, it's not only the business, the corporations, no, we can feel, the society can feel the effects into a China closing. But then last week China was like, okay, look, we're going to reopen, and we're going to reopen for full this year, right? So which market will be more profitable from that? Is it going to be the Europe, or is it going to be the USA, right? So this is my question for you, and I just want you type in the comments what you think. If you think if it's a US market, explain me why. I would love to know. And if you think it's Europe, explain me why as well. I would love to know. right? I'm going to give you the answer soon, and I'm going to explain why it's my answer. My answer can be right, can be wrong, it doesn't matter. I just want to show you why my view for now is Eurodollar changing the trend, okay, with China reopening. So if we think when China reopen, we have to think, okay, who is going to import from China and who is the closest countries from China, okay? So it's a basically geography, I would say, that we know that Australia are very close, Japan is very close, New Zealand is very close. So those are the three, very close to China. Australia, New Zealand, and Japan. Okay. Why I'm saying that? Why does it matter for the market who is close and who is far away? Okay. So I'm going to answer that question later as well. I just want to pop in now and answer who is the biggest importer from China. Okay. Let's see US first. So this is the website's TradingEconomics. I think everyone knows this website. It's a very, very good website. So this, it's just basically we are streaming the table with United States imports by country in US dollars. Okay, so the biggest, of course, the biggest importing that US have is from China. Okay, so they have 542 billions. It means that it generates 19% of their imports. And then we have 14% Mexico, and then 13% Canada, 4.9% Japan, and 4.9% German. Okay. Now, let's have a look at Europe. Okay, so when we have European Union imports by country, it's the same chart as this one, but now we change it US for European market. We can see that China have 23%, Europe have 23% of the items imported from China. Okay, so if we think about that, who is going to be more profitable from China reopening? I can guarantee in a way, with those numbers, this is not something that's going to change in a day or two. This is something that's going to, it can change, but in a very long, extensive period of time. So 2 years, 3 years, 4 years, right? So like from far, we can see here that China has 23% of the imports in Europe, okay? And then we have US with 11%. So this is a drop of more than 55%, okay? So it's a difference of more than 55%. So if we think who's going to be more profitable, of course it's Europe, right? Of course it's Europe. So then this is the catalyst movement that we may be waiting for changing the trend from a downtrend to an uptrend, okay? And this is maybe the area that we can start to see a small but very clear way to to get involved in a trade that we can follow the trend, okay? It's I think what happened? Okay, so now let's get back to ACY Securities website. And let's have a look on what I said here a few months ago. Sorry, not a few months ago, a few weeks ago, 1 month ago. So I've made two models and I want to explain those models, okay? So as I'm reading, I'm gonna put a few notes in the screen. Hope you guys can see it, okay? So first, model one, Eurodollar and Chinese imports from Germany, okay? So of course we have Europe, and then on Europe we have Germany, okay? Germany, the biggest imports from Germany is from China, okay? So in simple terms, I've basically calculated the expected value of the euro compared to the US dollar. That is just what I've done right now, by considering the effect of China reopening the economy and an amount of imports from Germany, okay? So I've also considered as well the interest rates in the US and in Germany, okay? So to my calculation, I used the data from the past 10 years and the past 5 years, all right? So my findings show that first, the amount of imports from China has consistent impact on the value of euro. An increase in imports by 5%, it's roughly equal to 1% increase in the value of euro compared to the US dollar. So what I want to say here is, so if we take all the imports from China to Germany and they imported 5%, right? So Germany have imported 5% from China. These 5% will represented 1% move up in Eurodollar. Okay, so if we open a new day, let's say we're gonna open tomorrow market daily candlestick, represents a 1% up. Okay, so it's one candlestick up. All right. So we have, as we all know, we have a candlestick close, right? So we have the close, we have, it can be the low, and it can be the open, all right? So if we take in consideration that 5% of imports, it's roughly equal to 1% increase in the value of the euro compared to the US dollar, meaning that if we have a candlestick opening here, it will be 1% movement up, okay? So that's roughly what I've, tried to explain here. I hope I'm not the best draw, but I think you guys could get it. Anyways, so back to here. So if we, and the second is, the amount of imports from China has a huge impact on our ability to understand the value of the euro, okay? So making the prediction more accurate. So importantly is, important here is, I find that a return of Chinese imports from Germany from the current level to its 10-year historical average of 2.9% would be consistent with Eurodollar rising to 1.15. Okay, so basically, if I take all the five years and 10 years and try to figure out how much they can import from China in 2023, I can have roughly more than 10% move up in, more than 5% move up in Eurodollar, okay? Meaning that we're gonna be close to 1.15, right? This is a long forecast, okay? This is not in a day or 2 days, in a month or 3 months. This is 1 year forecast. So I'm predicting Eurodollar at least 1.13 at the end of 2023, okay? And I'm gonna show you guys later, right? So this is the first one, right? So this is the first model. So moreover, Basically, I believe to be a rather conservative estimate for a couple of reasons. Firstly, my sample was including the period for Chinese restrictions, so this is why I've made the second model, I'm going to explain later, and which has pushed markets away from fundamentals and thus may have dependent the impact of my variable. It may be, right? And secondly, when imports do rebound, they are likely to run above the historical average as Chinese assumptions pick up. Right, so, okay, that's pretty much it for the first model. So the first model is basically we are looking at this level. And it may be the time to start to look for change of direction in the market. We are coming from downtrend, we may be starting to go for an uptrend. Okay. All right, so second model, it's the Eurodollar and direct impact on the reopening. So I'm not talking more about imports, but I'm talking about the reopening, okay? We all know that's going to happen. We all know that's going to happen. And last week, we could see China saying that they will reopen for full, and Eurodollar was already happy with that, okay? So if we go to the chart, I can come here to the chart, and you will be able to see that those last 7 days was more or less bullish, right? This is Europe being happy that China has announced that they will reopen for full, okay? Plus as well the quantitative tightening that I can explain if you guys want in the next video. So it's all, you know, can you stop for a second and see that everything is lining up for a change of direction in the market? So this is where I want you guys to pay attention, okay? Okay, so now the second model I want to present here it's basically, as I said, you know, it's Eurodollar and the direct impact of the reopening. So in addition to my model that calculates the expected value of the euro based on China imports, I also analyzed how reopening China could impact on the value of euro. Okay, reopening China could the euro. I did this by creating a simple model that consists of whether China is open or has restrictions in place. So basically, what I've done here is I've taken a few years that China was, you know, trading normally, and when China when China was closed. And what's the difference between those 2 years? Okay, when it comes to economics, this is pretty much what you do. You take a few numbers from here, put it there, you take a few numbers from there, put it here, and see the difference. See different scenarios, see what is happening in different, and try to put a story together, okay? So I also took into account other factors that have influenced the value of the euro in recent times, such as the difference in interest rates between the US and Germany, and surveys about the sentiment towards the euro area, which also reflects the impact of natural gas prices and the energy crisis that I have explained a few minutes ago on the beginning of the video. So I find that China's closure and restriction have shaved off about 5 big figures from Eurodollar, reassuring for the estimates of Model 1, right? The FV means fair value, estimate is now around 1.14. So it's just crazy how I've made 2 different models. Well, not much difference, but there is difference, and both of them are saying the same thing. Exactly the same thing. There's 1,000 points of difference. No, 100 pips difference from one target to another. Okay, but there's only one way. Okay, so it may be the catalyst event for Eurodollar changes the direction and starts to go up move. We have to see in the next episode. But just finishing here, you know, it is reassuring to see 2 different models, as I've just mentioned, drive the similar results. Okay, put differently, I think that a smooth Chinese reopening is not yet fully priced. Okay, it's not yet. But it's getting now there. in the price of Eurodollar. And it would imply an upside between 5.5 to 6.5% on Eurodollar. So that is what I was mentioned in the beginning of the video as well. Okay, so now how China reopening is going so far. So this was made, this was right in February 9. On that time, the fourth quarter GDP for China came in higher than expected. Okay, so the market was expecting a decrease of 1.1, but it actually increased it by 0%. It's technically an increase. We know that it's a break even, but it's technically an increase. Okay, when it comes to the economics value. So, and then the PMI, a measure of the economic active, has improved. So with both of composite and services PMI above the break-even point. So then the 51.1 for compost and 52.9 for services, higher than expected, 551. The housing market is still affecting growth, and housing sales have decreased slightly less than expected. Retail sales were negative 1.8% in December compared to the expected minus 9%. So that's a huge improve in the consensus. So everyone was expecting negative 9%. So as I was saying, everyone was expecting negative 9% and it came negative 1.8%. So that's a very big difference, right, on the numbers. So it was negative, but it was less than expected. However, the government support measures for the real estate market are likely to help it bottom out. Okay, so importantly, the first import data after restrictions were lifted showed an improvement, with year-over-year growth at negative 7.5% compared to negative 10.6% in November, and the expected was negative 10. The annual growth of imports from Germany to China was negative 10.9, which is still negative, but is an improvement from November's negative 17.5%. So the next import data will be available today, and this is what I'm going to be writing in a few minutes for you guys. So keep an eye on here, all right? Keep an eye on the ACY website, and we can see, what's happening on China right now. So that's basically all for today. We just have to pay attention right now on Eurodollar, just for one thing. Okay, let me open the chart here, because we have two big things that's going to happen this week. As we all know, we have this is FinLogic's website. Okay, so if you guys want to have accurate rates, if you guys want to have a very good news calendar, you can learn here. Please go to this website. This is a partner from ACY Securities, and you can draw lines. It's such a good place. Okay, you can post your analysis there as well. Look, and you can see my analysis there as well. So I invite you to come and have a look at the website. Okay, so we are here, basically on the Eurodollar daily chart. We can see that, I've told you 1, 2, 3, 4, 5, 6, 7 days, a little bit mild bullish. There is a few institutions talking about this level here. That's 105. Let me put it here, 105. Okay, so there are a few institutions talking about a retest on this level, and then an upside move all the way to 1.10. But for me, if the Eurodollar starts to climb higher and higher, I would have to see a close above 1.08 first, and then I can think about even higher moves. Otherwise, it seems a little bit stuck on this resistance area. Okay, so if we can move higher than 1.08, then we have 1.10, and then we have a free market to run. Okay, so keep an eye on that. I think we are nearly on an end of this downtrend, sort of downtrend move. That's more or less a pullback, to be honest. And then we can be looking at higher moves. And then if we break this top at 1.10 36.10, 36.5, we can have even more and more higher moves at all the way to my target. So I think that's all for today, guys. I hope you all understood and enjoyed this content. Please leave a comment, and I personally will answer to this, to your question. Don't be afraid, like, share it to your friends that are traders as well, and I see you in the next video.